Hello and welcome to another episode of the Mark Moss Show, where we're always talking about the way the world is changing as we look at it through the lens of politics, finance, and technology. And I like to bring to you some education, some ways to think, some late breaking news, and some interesting guests, and that's what I have for you today. I am joined by Peter St Onge. He is an economist at Heritage. He's a fellow at Mises. He makes daily videos on economics and freedom on Twitter, on the new Freedom platform on Twitter and on YouTube. He's a wealth of knowledge. I'm so excited to talk to him. We're going to go through a bunch of topics, including what is going on with BRICS and deglobalization, U.S. deficits, debt ticking time bombs, China, recession fears, real estate, Airbnb, and more. So let's just go ahead and just jump right in with Peter. Anyway, Peter, thanks so much for joining me today. We have so much to jump into. I'm super excited about this. I know, we've got to catch up at some events and stuff like that. We always have a lot to talk about. So I want to talk about, we'll start really big. We'll talk about like what the heck is going on with the deglobalization or decentralization, the rise of the global south, the BRICS. I want to talk about what's going on with the global homogeneity, the US Treasury Market. We'll talk about US deficits, the debt ticking time bomb in a lot of areas. What the heck is going on with China? Recession fears here in the U.S., even the real estate and potentially Airbnb bust that's coming. We got a lot to cover. But Peter, thanks so much for joining me.
Of course. Thanks for having me on, Mark.
So, man, we got a lot to discuss. We probably won't cover all that, so let's see what we can do. But, I wanted to start, high level and then kind of drill down is kind of what I was thinking. And so, one thing that kind of the main theme that I follow on this show is really this decentralization agenda, this deglobalization. And I talk about the cycles, this 250-year cycle of this pendulum that's swinging back from globalization to deglobalization. And you can really see it everywhere where we reached peak globalization with the WEF and the UN and the IMF and the BIS and et cetera, and NATO. But now all that's breaking apart. We have the rise of the BRICS. They met about 2 weeks ago. And to me, it seemed like it was sort of a nothing burger, but at the same time, it was massive. And the difference was the time frames that you're looking at it. But what was your take on that?
I think the BRICS meeting was not as exciting as some people hoped. There was no movement really on dollarization. I think, sort of the key there, the thing that people were looking out for was the possibility of BRICS doing some sort of gold-backed rail that would replace the US dollar. That would not be their national currencies, right? Because, China does not want a strong currency in the first place. Most of the countries in BRICS they're just garbage in terms of currencies. You got Brazil in there, which has a heck of a history. You got Russia, which has had, over 100% inflation in the past decades. None of these countries want each other currencies. So India and Russia keep bickering because neither of them want to accept each other's trash. So the question on BRICS is not going to be their crappy currencies replacing the dollars. The question is going to be some kind of gold-backed rail, presumably, mostly managed by China because they got the money. And the idea would be that, today none of those countries use the dollar at home, right? They use the dollar as kind of this outside, separate rail that they can do trade on. And so the idea would be that, say, China would back some kind of dollar replacement, and then they would do that so that they could suck power away from the U.S., right? Because if there's some cleanest dirty shirt in the world, right? If there's some option that's better than the U.S. dollar, then a lot of the U.S. dollar's sort of extra demand, okay, which holds its price up, a lot of that can sort of drain away. And, if we kind of zoom out, the thing about the U.S. dollar is that it's really been the reserve currency for about 80 years now, meaning that other countries, they use it for trade, they use it for investment. If you talk to a rich person in Mexico, he is not saving his millions in pesos. That would be insane. He's got a little bit of pesos for his month-to-month needs, and most of his assets are saved in dollars. That is true all over the world. And the end result is that there's about 2 to 3 times more dollars in existence than Americans actually need. Okay, all those extra dollars are floating around out there in the world. So if some kind of dollar replacement comes along, then people don't need those dollars. They sell them out in the market. Dollar starts getting weaker. That weakness scares let's say, Japanese banks who are holding, tens of billions of dollars. They sell those. All that stuff comes rushing back into the U.S. The only people in the world who are actually obligated to use the U.S. dollar, literally by law, is Americans. So if nobody in the world wants dollars, they all come flooding home. There are way too many as it is because we were the reserve currency for too long. That could lead to double-digit inflation here in the U.S. From China's perspective, they would love that because that would knock us out.
Let's unpack that a little bit. So there's two things at play. First of all, yeah, there was all this talk of they're going to launch this gold-backed currency. That got kind of knocked off the table even before the event happened.
Yep.
So I wasn't really expecting that.
Right.
But there was a couple things that I thought were important. So one, during the event, they talked about they urged the importance of each of these member states trading in their own currencies and outside of the dollar. That was one. So talking about that, so you said that they all have these different currencies and none of them really want each other's currencies.
Right.
But we see that they're trading in their own currencies. They're paying for oil in rupees, for example. They're paying for oil in yuan, et cetera. And I think about it like, to your point, nobody's obligated to pay with anything other than us as taxpayers with dollars. But if I want to go to Chuck E. Cheese and I want to play games at Chuck E. Cheese, I have to get the Chuck E. Cheese token.
Exactly.
Right?
Yep.
I don't want the Chuck E. Cheese. I'm certainly not going to store my wealth in Chuck E. Cheese tokens. But if I want to go there and play the games, I have to have their token.
Right.
And so if I want to do business with China, or if I want to get commodities from Argentina or XYZ fill in the blank, they could say, hey, you need my currency to get my Chuck E. Cheese games.
Right.
Now the problem is then what happens with so you have currencies and then you have reserve assets, and so we might break the dollar down into both. So the dollar as the currency and the dollar like the Treasury market as the reserve asset. So if we break those two apart, you have the reserve asset. Now I want to talk about both separately, but let's talk about the currencies for a minute. So couldn't they trade in their currencies? I guess they would just need a market then to take those trade imbalances and then stick them somewhere.
Yeah, that's exactly
like what they're doing with gold.
Yep. And the Chuck E. Cheese example is actually really good for understanding, how currencies work in general. So the United States is a giant Chuck E. Cheese. And if you want to do stuff in the United States, you have to use Chuck E. Cheese tokens in the United States. You have to use the U.S. dollar. And that's true everywhere in the world. Now, the thing is that most money demand, right? Most of the reason that people are buying money, it's not to transact in it, it's to save in it, right? So savings are probably 6 or 7 times more than the transactions themselves. And so when India, is buying oil in rupees or something like that, yes, it takes some of the demand away from the dollar, but the thing is that both sides of that transaction. So in the moment, if you take a snapshot when they're handing the rupees over for the, Saudi riyals or whatever, in that moment, the dollar's not part of the, party. But as soon as that transaction settles, they're probably going to park most of that in U.S. dollars, right? So the end result is that even though there's more and more trade going,
but are they parking in U.S. Treasuries, right? That's their reserve. That's
right.
Their savings.
Yep, exactly. Right. So from their perspective, a treasury is the same as a dollar. It's just got an interest rate on it. So, yeah, most of them are parked in U.S. Treasuries.
All right, I got to stop just right there. I know a lot of these things are pretty scary. Just know that one of the best ways to protect your wealth over 5,000 years has been gold. But it's hard to know which gold dealer to trust because there's a lot of fraud out there. I trust Universal Coin and Bullion because of their expert coin advisor, Dr. Mike Fulgens, who wrote the consumer alert on gold coins for the Texas Attorney General. Now, not only do they have trusted gold, they have great prices, and they have a very special offer for my listeners. You can get an American Silver Eagle coin with no dealer markup for just $27 each with a limit of 3. And they're even going to send it to you for free and an award-winning gold investment guide. Now, the Silver Eagle gold coin is the most sought-after pure silver bullion coin in the world, and you can get it from them for this special deal today. Give them a call, Universal Coin and Bullion, to get this $27 Silver Eagle coin deal today. Plus, great prices on gold, give them a call, 1-800-UCB-GOLD. Again, 1-800-UCB-GOLD, or go online to universalcoin.com/Mark Moss. But I think about, like my wife, she's sort of ridiculous in this way where she loves her like Starbucks card, and she loves to put money onto her Starbucks app. So when she goes to Starbucks, she just shows her app and they credit it. Starbucks has $2 billion of float sitting in their gift cards.
Right.
So people do store wealth in Starbucks, apparently. $2 billion of it, right?
Yeah.
And so it's sort of like a float because they know they're going to go to Starbucks and use that at some point. And it's not even a Starbucks token. It's just the dollar.
Right.
But yet they'll still park it there. So it could be possible where I'm going to do $2 billion of trade with India. I might as well just keep some rupees.
Yeah, without a doubt. I mean, there is going to be some of that. So the reason that you save, sort of zooming out in the big picture, is so that you can eventually engage in transactions, right? So if a significant amount of the trade going on between, let's say, Saudi Arabia and China is going on in their own currencies, then yes, there will be some deterioration of U.S. dollar demand, but I don't think it's massive. So it's not like one-to-one. In other words, if 10% of their trade shifts out into each other's currencies, that doesn't, I think, imply a 10% drop in how many dollars they want, because most of the dollars they want are kind of saved for we don't know what yet. Okay, so it's just a store of value. It's not necessarily dedicated to any purpose. So yes, those will weaken the dollar. And I think everybody pretty much expected that out of the summit here. All of the countries in BRICS are trying to extend how much trade they do. They're also trying to bring in new members. They've got something like 40 that are knocking on the door. And yes, that will drain some demand away from the dollar. I don't think it's an absolute game changer like gold might be. But it looks like gold is a ways away. Now, the thing to keep in mind, because the dollar is a funny creature because it's the reserve currency. So in 2008, the global financial crisis, that started in the U.S., right? It started with, risky mortgages and with banks that took too many gambles. And even though it started in the U.S., then it spread all over the world, Europe and Asia, the U.S. dollar actually got stronger during the global financial crisis. And the reason is because if you are the reserve currency, you're seen as the safe haven. Even if the problem is coming from your own country, from the perspective of the whole world, the U.S. dollar is still seen as a safe haven. So on the one hand, BRICS could drag demand out of the dollar, which would weaken it. On the other hand, if we look at the world, largely speaking, we've got near recession in the U.S., we've got outright recession in Europe, China is going through a rough patch. There's so many problems in the world that it would not at all be surprising to actually see the dollar get stronger, even as that sort of structural demand is fading away because it's being replaced. So you have basically temporary demand because people are scared.
Yeah, which it is. The dollar has been rampaging its way up right now. But if we go back to this sort of Chuck E. Cheese analogy, so we don't want money. What we want is the things that money buys us, the goods and services. Yep. We wait in money until we're ready to get those goods and services that we want. So back to the Chuck E. Cheese analogy, what we want is goods and services. Now, the U.S.'s main exports we have goods and services. Most of what we export is services, financial services, social media services. Putin said, what are you going to do, eat your social media stocks? Now, as far as goods, the top three exports in goods are energy. Mm-hmm. But if with the addition of Saudi Arabia, Iran, I think they're up to about 80% of the global energy market. Or oil market, I should say. So if these BRICS nations, the Brazil, the Russia, the Saudi Arabia, et cetera, if they're the producers of goods, then the world needs what they're producing versus what is the U.S. producing that anybody needs.
Yeah,
nothing.
And that's a fundamental problem. Really across the West, they're chasing out manufacturing, they're chasing out energy. They're generally doing it in the name of the climate. And of course, they're just sending these overseas where they're often produced even dirtier, so none of it makes any sense. But it's crony. There's a lot of money at issue. So we're chasing out all of these sort of real industries, and we're essentially handing them to these other countries. Right? Germany is just deindustrializing it. at a ridiculous pace all across Europe.
Breakneck speed, yeah.
Yeah, they're buying out farmers and slaughtering cows, and so you are essentially handing the keys to your future to these other countries. Now, the thing is that the countries who it's being handed to are the countries who are not part of the Western gang, right? They're the kind of countries who don't listen to environmentalists or the rest of the activists. So almost by definition, you're taking all of the real industries, basic materials, minerals, even food, and you are handing those to countries that sort of by definition don't like you. They're not part of your gang. And so this kind of sets up a 1970s oil crisis type situation, but completely across the board, right? Where we're not there yet. We're going gradually. We're going as fast as the activists can push it. But we're gradually, all of these things are coming from countries that are actually hostile to you. If those countries are talking to each other, then you could conceivably have an OPEC-style coordination where they start squeezing the West. And, the West does have things they want, like money. So, they could essentially make the West dance. Even if the Western economies are much bigger on paper, they don't have those leverage points. A lot of countries in the world would dearly love for, say, Facebook to pull out, either so they can promote a national champion, or they don't frankly need it very much. They might see a company like Facebook as a problem, that it encourages activists or color revolutions and things like this. So from those countries' perspective, there's very little leverage that you can throw back at them if they do decide to use their control of basic materials and energy to squeeze us.
Yeah. So going back to, we don't want money, we just want the things that money buys us, but we have to store that weight. We have to store our value in something where we can wait. And so the dollar, the Treasury market has been that. Mm-hmm. And I think, we'd both agree, most everybody agrees that there's really no replacement for the US Treasury market. We don't have the bond markets, the deep liquidity markets. We don't really have, even as much trust has been lost in the US system, there's less trust in other places, et cetera.
Yep.
But it seems like what a lot of these BRICS nations have been doing is moving their treasury buying into gold buying.
Right. Yeah.
And so that has been a trend that we've been seeing over the last couple of years. And so if they need to park their trade balances, their reserves in something, then, well, they have all these other assets. The dollar is the best, but maybe gold is also good as well. And it seems that that's the trend.
Right. Gold is good as well. Also hard materials. So, what China's been doing is plowing a lot of money into Africa. And it will, what it gets on its end is that it might own an oil field or a mine or something in these various countries. And so that's essentially a hard asset. It's not quite gold, but you put a bunch of those together and it serves the same purpose. And probably the biggest sort of own goal there is that when Putin invaded Ukraine, the U.S. actually seized Russia, the sovereign dollars of the Russian central bank. And they did that to try to set off a bank crash. Now, ironically, our banks crashed instead for separate reasons. But what that did was warned the entire world, right? It warned the other 200 countries in the world that the dollar is a very risky thing to own now, because if the U.S. government decides that it doesn't like your policy, then they will crash your economy. And now, if you're a country in Africa, let's say that you're kind of dodgy on the democracy front, the prospect that the U.S. could crash your banking system, that does not mean that you're going to have embarrassing press conferences, okay? That could mean that you're hanging from a pole, all right? That's a very, very serious threat in some of these countries, and the U.S. just jumped right in. During the Cold War, we had multiple hot wars going on, proxy wars going on with the Soviet Union all over the world. We never ever did that because we were run by grown-ups who understand that you want to let or keep the entire earth dependent on you. Yes, even your enemies. So in this case, it's not only was it just blindingly stupid, but for me, it's an interesting input into the whole debate about the petrodollar and whether the U.S. is going to run around doing in world leaders who reject the dollar. They have been so incompetent at managing it. I don't know if they're too stupid or if they are so beholden to the activists that, the sort of Kissinger type realpolitik grown-ups in the room get ignored and they just do whatever the activists want. They've been throwing weight around recently. Japan had a big debate about LGBT policy. Uganda had a law that's very harsh on LGBT community. And the U.S. has been pushing on that. They actually put sanctions on Uganda. They said, we're going to review your duty-free access because of this law. Right. And so that's an escalation here, because it's one thing if your country's afraid to invade your neighbor because you think the U.S. will crash you. It's another thing if now that's starting to get into environmental, union, family, right? The typical African is not woke. They're very much not woke. Yeah. They're not into this kind of thing. Uganda cannot do that kind of policy. So at that point, for a lot of these, or Saudi Arabia or Indonesia, which is Muslim, so those countries are basically backed into a corner where, they saw what the U.S. did to Russia. Who knows if they're coming from them? They don't know what the rules are. It's a lot like us on social media. Like day to day, you have no idea what you're going to be censored for. These countries have no idea what transgression is going to get the activists excited about them. Meanwhile, you have China over here. And China's deal when it comes to developing countries is they say, we don't care what you do politically. We want you to be rich because we want to buy stuff from you, like oil. We want you to have functioning oil fields and ports. And we also want you to buy Chinese things. All right, so we want you to be prosperous. And aside from that, I don't care what you do. Doesn't matter to me what you do with the environment, LGBT, etc. That package looks a heck of a lot more attractive to a lot of countries, and those countries collectively make up a huge amount of dollar demand. There was a Larry Summers. He gave a talk, and he was former Clinton executive. I think he was Secretary of Treasury. Anyway, he was running around Africa, and he said that he talks to diplomats over there, and what they tell him is that when China comes, they come bringing a big checkbook, and they ask, what do you guys need? And here's what we want, and let's make a deal. When the U.S. comes, they come with a lecture.
Yeah. Yeah, it's something that I've been observing, and I am certainly no China champion at all. Sometimes I get accused of that. It's crazy, but I'm certainly not a fan of communism, nor am I a fan of China. But if you do look at it through the lens that you're talking about, it's like China is cooperative, and the U.S. is coercive.
Yeah,
and it bothers me because when you look back through World War I, World War II, and you see the rise of the United States, and really coming to this point of American exceptionalism, and it really led through this industrialization and being able to supply the world, and we led by example.
Yep.
And today it's coercion to the point that you've had, where China seems to be cooperating now. Do they have ulterior motives? And there's a whole bunch of other stuff to unpack there. But on the surface, you sort of see that. I want to just wind it back if we can, just a little bit, because you talked about the petrodollar. So after the whole world, per the Bretton Woods Agreement, was tied to the dollar, Nixon ended that 71, 74, went into this petrodollar agreement, which basically ensured the Chuck E. Cheese token would have value because the whole world needed energy, and so we priced the whole world energy in dollars.
Right. Yeah,
right?
We provided free.
Yep. And so then if oil is no longer in dollars, then what does anybody need the dollars for? Because there's nothing in the Chuck E. Cheese store anymore. Yep. Now, there's lots of debt that's denominated in dollars that has to be paid back. And so this is something Brent Johnson and I have gone kind of round and round on, where he's like, but you got to pay back the dollar-denominated debt.
Right.
That has to be extinguished. Well, unless they don't want to pay it back anymore.
Yeah. Yeah, it's the old joke, if you owe the bank $1 million, you have a problem if you owe them, right. And there's some point where there's so much debt out there that if countries decide that they would like to collectively stiff the U.S., there's honestly not much you can do about that. I think so.
Well, you got an Austrian potentially rising to power in Argentina.
Yeah.
And he's pushing back big against the debt, wanting to restructure what they have as debt, change that whole system. Then you got Ukraine, which seems like there's no way they could win that war.
Yep.
And the three largest debtors to the IMF are Ukraine, Argentina, and Egypt.
Right.
So what happens if that debt just goes bad?
Yeah, well,
which could happen. Which could happen.
Oh, yeah, it could for sure happen. And, the IMF has this Baroque siphon that it's plugged into the taxpayer wallets. And so the IMF will do just fine. It'll just come straight out of us. It's called a requisition. They basically send out notice that everybody has to give a certain amount of money, and you, the taxpayer, have to do that. It's unclear to me why exactly we have to obey that. But anyway, we do. But, yeah, I think that the petrodollar thing, so my understanding of it, just in summary, is that the U.S. provided free mercenary services to Saudi and a number of other countries, protecting them against Iran or whatever other interlopers, presumably actually protecting the Saudi family against its people because it was deeply unpopular for a long time. And in return, the deal was that they would, when they sold oil, they would park the proceeds in dollars, and then that would boost dollar demand. I don't think that's a huge amount of dollar demand. Just to grab a number at random, like 5%. It's a relatively small amount of dollar demand. I think mostly the reason why people in the world use dollars for various things is because, first of all, the Federal Reserve is actually not that bad compared to other central banks. It's horrible compared to our ideal world, but in the grand universe of central banks, it's not that bad. It's about the same level as the EU, arguably Japan. So for most of the world, that's attractive. It's certainly better than the Argentinian central bank. So that's part of it. And the other part is just that there's kind of this installed base of the U.S. dollar from, for a long time, the U.S. dollar was the only gold-backed currency up until Nixon, and everybody else kind of piggybacked on that. And so that gave the U.S. a really dominant position where everybody was using the dollar because the dollar was effectively gold, but it was a form of gold that was very, very cheap to transact. Okay, so when it comes to currencies, those transaction fees are a really big deal. Why can't world trade happen in Samoan, whatever the currency is of Samoan? Because there's not enough.
Right.
It would be enormously expensive to try to move.
No liquidity.
Yeah, exactly, right. If you try to move $1 billion in, Samoan dollars, then, you're going to pay 30% transaction. I don't know. And so the transaction fees are so low in the dollar that at this point, it's sort of running on fumes. It's got that installed base, and that means it's a relatively liquid market. Now, eventually that flips. Something like, gold rail would probably flip that a lot quicker. China is trying to essentially bribe countries off the dollar. Biden is really doing China's job for it by doing this, this funny business with the Russian central bank and then pushing Uganda around. Again, Uganda economically is an inconsequential country. It doesn't account for much dollar demand, but there's a lot of countries in the world who look at Uganda. So countries like Brazil or Egypt or India who do hold a lot of dollars, and they look at what happens.
Yeah. So let's jump over to now, I think something you had talked about was Japan and China dumping dollars. You said, I think, at a record pace.
Yeah.
So it looks like we have Japan, China, but not just them. Potentially other countries, even Germany, dumping treasuries for any number of reasons, presumably to either, one, prop up their currency, or two, to buy energy. So what's your take on that?
Yeah, so it's happening all over the world, but it's really most dramatic in Japan and China. And what's happening is that the gap between their interest rates and our interest rates, right? So we have pretty high interest rates right now. It's about 5.25. China's at 3.25. Japan actually still has negative interest rates, minus 0.1%. So that creates a big profit opportunity to move your money into the U.S. So you've got all of this money flowing into U.S. assets. That is causing those currencies to plunge in value. So the Japanese yen is down. It's down about 7% in 2 months, which is a really big move for the yen. It's actually down 40% since the pandemic began. China is hitting, I think it's 15 or 16-year lows that it just hit. They're really losing a massive amount. So there's a big problem politically in those countries because, especially Japan, it imports essentially all raw materials. Most notably, it's gasoline. 100% of the gasoline in Japan is imported. And so if the currency is getting too weak, then those prices jump, and then households get upset, and they put pressure on politicians to fix it. What happens at that point is the simplest way for a Japan or a China to try to fix the currency is to sell their U.S. dollar assets, which are overwhelmingly in U.S. Treasuries. Okay, so they sell those, they flood out the dollars, and they use those to buy back their own currency. Okay, so if they do that, then that can reverse the slide, or at least it can hold the currency stable enough that they don't get political problems. But what that means is that Japan and China have been two of the biggest buyers of American federal debt. And the Fed right now is saying that it's going to be selling $60 billion, or it is actually selling $60 billion a month in US Treasuries. And so if the US is selling, China is selling, Japan is selling, who the heck is buying? Right? And meanwhile, you've got
and the
Biden
BRICS are buying
over here.
gold.
Yeah, exactly. Right. BRICS are buying gold. Countries all over the world are gradually diversifying out of the dollar. So, the yen and the euro have about doubled their market share for official reserves because of that Russia thing. So everybody in the world is essentially selling treasuries. And then you've got Joe Biden on the other side here ramping up the deficit. So we're looking at, I think it's 1.6 at this point, 1.6 trillion a year.
Yeah.
And it's looking to get towards 2 trillion. The CBO, the Congressional Budget Office, which is like the in-house accountants for Congress, and it's bipartisan. So they estimate that we're going to be looking at deficits of $2 trillion per year up until 2050. So who on earth is going to buy all that?
Yeah, I just saw the last Treasury auction had record amount of oversubscribed. I mean, they had more demand than there was available. I didn't get a chance to dig into the data to answer that question. Who is buying?
Yeah,
if it's not Russia, it's not China, it's not Japan, it's not the BRICS. Who is it? I'm guessing it's Switzerland, it's Europe, and it's the banks.
Yeah, Switzerland, Europe, the banks. Partly it's that flight to safety. So enough things are going wrong in the world, especially with China now going down. You've got instability essentially in every major region of the world. So some of that is going to be kind of transitory demand for dollars, which translates for the most part into U.S. Treasuries. So I think in the near term, we're certainly not looking at any kind of collapse. But I think going down the line now, as China and Japan drain out, as the Fed drains out, you've got this big overhang. And you may not see it immediately if there's enough fear in the world that people are going to that cleanest dirty shirt. But I think that's setting up a lot of trouble for us down the line, especially since there appears to be absolutely no constraint on how much debt both parties are united in pushing out. So I think we are looking at, we all know it's unsustainable, and the question is that accelerating?
Yeah, well, I think that certainly is accelerating. We saw pre-pandemic, the budget was 4.8 trillion, and now it's up to 6.4 trillion or something like that. And so that new level has been baked in. At the debt ceiling debate, they did not want to knock that down at all. And as a matter of fact, to your point, the CBO is just projected to get higher. I saw that the U.S. government spending is now greater than 25% of U.S. GDP. So that fiscal spending makes up more than a quarter, which is past where we were in the 2008 great financial crash. And we're not even in any type of economic downturn. Like, this is like wartime deficits, and we haven't even seen a recession yet.
Right, and remember, there's state and local and county and all the rest of it. You put all that together, it's about 10 trillion. So it's over 40%. It's almost half of what we produce gets taken by the government. And you're exactly right. That's during peacetime, and we are absolutely running wartime style deficits. Our deficit numbers look like what they were at the absolute worst of 2008. So the concern there is that if we get a recession coming on the pike here, last time around we had I think it was 2 or 3 trillion in 2008. It was 2 trillion in 2008, and it was 3 trillion in 2020. Every time you have a recession, the deficit absolutely explodes, because on the one hand, you have a lot of people who need help. They lost their jobs, or they're having some other distress. So social spending soars, but then on the other hand, tax revenue dries up because nobody's making any money. So every single time, it gets bigger and bigger. So we're looking at probably, if I had to guess, another 2 trillion plus on the deficit when the recession finally hits. And the other issue, I think, is one of the most exciting things about recessions is that every single time the left comes up with some new innovation that's going to permanently grow the government. And I think they sort of ran it on a trial basis during COVID. They are, I think, hell-bent on installing a UBI, a universal basic income. And I think it's very possible because of that this next recession could blow 2008 out of the water. It can even blow 2020 out of the water in terms of how much spending is ramped up, because I think they're going to go all in on a UBI. That will give them the bread to go with the circus, where they can, essentially pay millions of voters to sit on the couch and give all the rest to them.
Well, I think there's no question. I mean, there always is, but I think it's in my view, overwhelming probability that this next recession is going to blow way past what we saw in the pandemic. But fiscal monetary was about $11 trillion. Will probably be 15, 20. In the next one, because the holes get bigger, they have to fill them up. But back to the point that you said, talking about the UBI, Universal Basic Income, don't we already have that? I mean, we already have housing, we already have food, we already have don't we already have UBI? In a sense, it's not called that, but we certainly have it.
Yeah, for sure. Certainly in terms of how much money it costs, probably in terms of how much it disincentivizes work and just sort of, making the correct choices in life. Like designing a welfare program that only gives single mothers money if they kick the man out of the house. What could possibly go wrong? What could possibly happen to a community subjected to such a rule? So they're really wrong-headed. And, in terms of money, absolutely, we already have a UBI. And this, if we look at COVID, for example, I mean, they just laid it right on top. They didn't repeal anything whatsoever. The pitch that you'll often hear out of Washington from sort of the Mitt Romney types, the quote-unquote centrists, is they'll actually push UBIs because they say, no, we're going to take the current inefficient welfare system and we're going to replace that with this real simple one that's just no questions asked. And, we can cut the paperwork and, it's a lot more rational and all this. And we've actually been there. We already got baited and switched on that one. That was the EITC back in, I want to say the 70s or the 80s. The EITC, the Earned Income Tax Credit, that was sold as a negative income tax, and that was precisely the pitch. So again, we're going to replace this ridiculous welfare system that breaks up families and puts people in poverty traps. We're going to replace that with this system now where you got to go get a job. If you make $1,000, then you get another $450 in taxes. It's a clever idea. It was Milton Friedman came up with it. From an economics perspective, it's a very clever idea. From a political perspective, it's absolutely idiotic because they didn't repeal a darn thing. So right, that's the pitch that the centrist Republicans are going to come in with. The Democrats are going to try to bring them on board. The Democrats just want to buy votes. The centrist Republicans, I guess, want to get cushy jobs when they leave Congress, courtesy of their friends on the left. Either way, that's kind of the unholy coalition that is forever victimizing us. But anyway, they're going to be at it. The Democrats don't listen to me. Some of the centrists I can sort of intimidate. So I'm definitely going to be going after it for them because I'm certain that's exactly the game that they're going to pull.
Yeah. Now, when you look at the need for this UBI, et cetera, I mean, we kind of have, like I was talking about earlier on an earlier segment of my show, just like the tale of two markets almost, or two economies and two markets really, where you have in the economy specifically, we have really, really good signs, so strong earnings and strong revenues and strong consumer spending. But then we see dwindling savings and massive amounts of debt.
Yeah.
Right, we're starting to see delinquencies piling up on credit cards, auto loans, et cetera. And the markets are the same, where the equity markets look really, really good, but the treasury markets, the bond markets are telling us trouble's coming. So we see these tell of two things. But I'm curious, we see that we have this massive amount of rising debt, both on the federal level. They've added about $1 trillion in the last month or so, but also on the consumer level. And not just consumer level, but also, corporate level as well. And while it seems like most eyes are on the federal debt, the government debt, which is obviously exploding, right? I said $1 trillion last month. The reality is that they don't default because they have the money printer.
Right.
It seems to me that the bigger problem is really in the private debt, and that's the sector that's probably going to blow up first, and they don't have a money printer to back that up. I'm curious on your thought on that.
They rent their money printer to lobbyists. So, yeah, depending on the industry, they do have a money printer. But we plebes definitely do not have a money printer. So we are on our own. We have to beg for our scraps and our UBIs. Yeah, I think definitely the private debt is an issue. Currently, it's not biting as hard as you'd expect, really for two reasons. One of them is that during the pandemic, there was a huge amount, about $3 trillion of excess savings. So they handed out all this money, and people who were poor kind of used it up real fast, but a lot of the middle class saved it up. I suspect your stimmy checks were saved. Mine certainly were. And so that's been running down. And so the Fed now estimates that is going to run out in another month or two. And then the other reason why it hasn't bitten quite as hard as you'd expect is that a lot of those debts were incurred in absolutely historic lows in interest rates, right? So a lot of people are still driving cars where they've got 0% loans on them, or mortgages where they cost 3%. So just because the rates come up, that doesn't hit all at once, right? You sort of have this gradual, person by person, their old debt is done, maybe it's paid off, and now they're coming for new debt. So the problem builds gradually, and that's part of the reason why there's typically about an 18-month delay between when the Fed hikes rates and when the economy actually hits. Companies have old cheap debt, households have old cheap debt, and so that's going to get run through gradually. And where we are on that timeline, the Fed started raising, I think, a little over a year ago, from roughly zero, but rates didn't really hit a restrictive level, meaning the rates that we saw before 2008 or before 2001. Pretty much before every recession, you get higher rates. In fact, that's what causes the recession. But anyway, we didn't hit those restrictive rates until like 3 or 4 months ago. So we're still very far away from when you would expect the recession to hit in full force. And, that's why a lot of the debate right now is you've got the cheerleaders saying, no, this is Goldilocks. My God, Sully landed the plane on the Hudson. Jay Powell is amazing. We're going to have the soft land. It is way too early to take victory laps. And in fact, given that it's so early, right, that we've only really had restrictive rates for a couple months, the fact that we're seeing bank collapses and we're seeing a lot of statistics like bankruptcies, layoffs, mass layoffs. We're seeing a lot of statistics that are 2008 level, and we are way early in the rate hikes to be seeing that. So that's why I think when the recession comes, I think it's going to be pretty brutal.
Yeah. The question is when, right? And that's always the thing. And the one thing that I just have to constantly check myself on is, through the Austrian lens, through a rational lens, you can see this is unsustainable. Mm-hmm. I got caught really hard in the 2008 great financial crash. And that's what really got me interested in macroeconomics and kind of drove me down that rabbit hole. I latched onto Mike Maloney, and I became a gold bug, and I'm watching Peter Schiff and Harry Dent. And, then 2012, 13, 14 comes, and I'm just waiting for another bank collapse. No, it's going to crash. It's worse. They didn't fix it. It's only worse. Oh, my gosh, this is horrible. Oh, now we have Obama. Now there's more spending. It's getting worse. And, 15, 16, 17, it's going to be another crash. And, the Harry Dents and the Peter Schiffs, they're the broken clock that will be eventually right.
That's the thing
that I've said. That's the thing that I've said to Harry Dent. I've had him on a couple times. He spoke at my conference. I've read 5 of his books. I believe he's right. His research is right. His assumption of thinking he can choose the time is what's been wrong.
Yep.
And we fail to see how many more potential tricks they have up their sleeve. So you mentioned the banking crisis, for example, and they raised until they broke something. Now, Jerome Powell told us in a meeting that he said the fear is not doing enough. He would rather go too far and break something because they have the tools to rebuild, right? And so they did. So they broke the banks. But the reality was they opened up some new 3-4 letter agency, PTFP, and saved the banks. Now, whatever, a bank or two went down. Consumers didn't really get affected, didn't miss a beat. And so what we saw during the pandemic is they opened up dozens of these 3- and 4-letter agencies, and they were buying corporate bonds all the way through buying equities, indirectly. Mm-hmm. And so the question is then, how many more of these are they willing to open? And how many? And they've already opened up, unlimited swap lines with, European countries. They've already set up these facilities. So I guess they could just keep pushing this out way further than any of us think is kind of the realization that I'm sort of coming to.
Yeah, I think you're absolutely right. We know how the book ends from history, but we have no idea how each chapter ends. And I do think that there's a lot of chapters between here and the end. I think they can keep it going for a long time. And, so usually I am all in equities. In fact, usually I am in options, and I'm overexposed to equities because I like risk. Equities are usually the way to go. Almost always equity will beat everything else. It'll beat treasuries. It'll beat gold. And the reason is because people forget an equity is a hard thing. Okay, like Apple, if you buy a share of Apple, you're not buying a altcoin. I'll use the polite term. You are buying a company that has a brand, that has engineers, that has factories, that it has contracts with. I mean, equities are actually real. You can drop them on your foot. So no, I mean, in normal times, I'm a huge fan of equity. I think buy like SPY, SPY, the ETF. It's got low fees. Just fire and forget. Don't even look at it for 10 years at a time. You'll be absolutely fine. Now, in the moment, I am in gold just because when they've hiked rates about the fastest rate in 50 years. Every school of economics, it's not just Austrian, it's Chicago, it's even the Keynesian freaks. They all know that hiking rates that fast is going to crash the economy. So at the moment, I'm nervous, but normally I'm like an equity bro.
I love it. And when we look at a lot of the indicators showing these recession fears, the one that people point to all the time is this yield curve inversion, which has been right. It's accurate. It predicts every single recession, but it doesn't tell you when. And so, like, the yield curve could even get more inverted than it is here.
Yes,
it could stay inverted for a really long time, and it's typically when it re-steepens, which is when really it comes. And so, like, could it stay inverted for another year? I mean, I guess it could, right?
Yeah, I think without a doubt. A lot of Wall Street operates on statistics. Like, they don't have much theory. So they got a bunch of, useless Harvard grads who sit around and just correlate crap. And so, I mean, they will correlate everything under the sun. There'll be like milk prices and, dividends at aerospace. I mean, they just correlate everything. And then if something jumps out, they're like, snap, I got a correlation. They back test it. They do the statistical whatnot. That's really how they operate. They have no idea why anything is working the way it is. And, in the case of an inverted yield curve, what it's really telling you, all the inverted yield curve is telling you is that the Fed is going to cut rates. That's it. Okay. Now,
in the future,
exactly. Who knows how long in the future? I mean, generally, the yield curve has a built-in estimate of when it thinks that will occur. Okay. So,
which would be the 30, the 20, the 10, the 5,
bingo,
right?
Exactly. And so then at that point, you have to use theory, or at least understanding the world. And you have to say, okay, what kinds of scenarios does the Fed suddenly cut rates? And usually the answer to that is when a recession comes. And so then the Fed panic cuts because it raised rates too much. It toppled the economy over the edge. And so now the Fed's trying to clean up its mess before anybody notices. So usually that's when they panic cut. In this case, it is weird because rates or because inflation is so dominating what the Fed does, and almost everything it does, whether it's going to have high rates or low rates, it actually doesn't have much to do with the economy. Jay Powell's been very open about that. He's basically been saying, let whoever dies die. This is not my problem. My job is inflation. And the reason for that is because the Fed knows that inflation is how it gets fired, right? Inflation is the fundamental thing that the voters are going to sort of grade it on, and that means that's the fundamental thing Congress is going to consider when people like Ron Paul try to agitate for more control over the Fed. So the Fed knows that it lives by the mercy of Congress, and the one thing that could really make it lose its independence, this has been true through centuries of central banking, is if they screw up inflation. So that's why Powell cares about inflation. It's not because he cares about us. But his job is to make inflation.
Isn't it the dual mandate, though? So it's inflation, stable prices, and full employment. So, right. I mean, theory, which is hard for them, but in theory, would you rather have a job and income and more expensive prices,
right,
or have no job or income and lower prices?
Yeah,
I'd probably rather have income and higher prices.
Yeah, yeah,
and so then there's a combination. So to the point of the Fed getting fired because the people are upset, like I would think the people are probably. If unemployment goes from 3% to 6%, you put 5 million people out of work. Well, 5 million people out of 330 million, it's not too bad.
Right.
I'd rather keep the majority of people in work with a little higher prices. And so it seems like there's a combination of those two levers.
There should be. I think the difference is that unemployment is, really it's not unemployment, it's loss of income. Right, from their perspective. And that you can fix with the stroke of a pen. We just got done fixing it in 2020. So what was that? I don't know, $2 trillion, whatever it was in stimmies. Those are very, very easy to pass. Like Congress takes no damage passing a massive stimulus check. They fight over each other.
But then we go back to the inflation, though.
Yeah,
go
exactly.
back to inflation.
Right. Yeah. So if the Fed screws up too badly, and that's that's part of the reason why when Jay Powell gives his press conferences, he's always talking about slack in the job market. What he's basically saying is that I think that there are enough people with jobs that we can lose a couple million of them, and we're not going to have political trouble with Congress. So he's using them as cannon fodder. And, if that gets out of hand, then he loses too many and we get back to a 1970s situation. That's really what he fears. On the one hand, Congress would go to town with stimulus checks, but that is really, Powell is trying to sort of do that trade-off, hence kind of the soft landing, right? His hope is that he can get inflation down, sacrificing just a couple of million workers, but not so many that it gets out of hand for him politically. So that's really the trade-off that he's going after, and that's why every single month he's just absolutely obsessed. How many jobs have we lost? It sounds kind of, like he's a vulture, but I mean, that's fundamentally what he's doing. He's trading workers to get inflation down because he perceives that from a PR perspective, the inflation right now is more trouble for him than the workers are.
I want to jump to another topic and see how much time we have left. But, I started my career right out of high school buying bank-owned repos and fixing and flipping. I've been involved heavily in real estate my whole career at this point now. And so it's something I pay close attention to. A lot of people are just forecasting absolute death and destruction in the real estate market, but for some reason the market just doesn't go down. For lots of reasons, which we know, people locked in debt, et cetera. But people, they're saying it's part of it I think is that the general is always fighting the last war. So because 2008 was a housing crisis, they think that we have to have another housing crisis. I don't think that doesn't have to be that way. And so a lot of people have been forecasting this. It hasn't come to pass yet. Now, sure, the sales numbers are down, et cetera, but the prices have maintained. But now, over the last week or two, all the war drums are out banging on the table. The pinprick is here, and it's the Airbnb market. The Airbnb market's going to come crash it, and I think you were telling me that you just recently wrote a paper or did a video on that topic. So give me your breakdown of, I guess, the real estate market overall, and then the Airbnb being a prick for that.
Yeah, so I got a video coming out on the 10th, whenever that is. So probably a couple days from now.
So sneak peek.
Yes,
sneak peek.
Yes, it's a sneak peek. Yeah, housing has been funny. So when rates were so low, when all the big housing bubble was going the past couple of years, I actually stretched and bought the maximum house that I possibly could because rates were obscene, right? They were sub 3%. That's like free money. And inflation at that point was going, 7%. So, effectively the Fed was paying you 4% to own a house. And what I figured is that, sure, it's a bubble, okay, but the bubble, it'll go up, it'll start to come down, but then it meets inflation coming up to meet it, okay? So I figured that was actually a pretty good hedged trade, that inflation would essentially catch up with the prices. And we've seen that for over a century, that house prices almost perfectly track inflation. You get a little bonus if people are moving to Orlando and they're moving out of Chicago or something. But, on certainly on a nationwide level, houses are just a proxy for inflation. That is, by the way, if you're considering, gold or something, I mean, a house is a heck of a hedge, particularly since you can generally, not at the moment, but generally you can get really cheap money from the Fed. It comes from the bank, but the bank, of course, gets it from the Fed. So, you are getting I think in our case, we effectively got about 2/3 of our house for free, courtesy of the Federal Reserve, which I didn't ask for in my defense. But anyway, there we are. Okay, so I don't think it's guaranteed that housing is going to go down.
The other thing just to throw out there, because it's important, I think, for greater context, is that what a lot of people miss about real estate, especially the Bitcoiners, is that, sure, the yields aren't that good, depending on where you're at, your cap rate, 6%, 8%, whatever, that's pretty good. But to the point that you made, the leverage, the free money. I'm getting to leverage $1 million asset for $100,000 for 10%, for example. So you have the leverage. But what you also have is you have two other things. So one, you have depreciation that they give you for tax write-offs. And depending on where you're at with your income and your tax write-offs, that is a big deal. And then, potentially, historically, you have appreciation over the total asset, not what you've put into it. So there's really 4 ways that you earn on real estate. And so that's why, and then there's ways to shield your income in real estate. So like you could effectively pay no income tax if I have a good real estate strategy as well. And so I think it's important to understand those metrics if you want to look at the real estate market as to what it's doing. But anyway, sorry, keep going.
No, you're absolutely right. Normally, the regime only rewards miscreants. But in the case of housing, like for one time in your life, the regime is actually giving you freebies. So, yeah, absolutely. I'm a massive fan of housing as an investment for all those reasons. Airbnb specifically, the story there is that the rates are coming down. You got a lot of people around the country who, stretch to get that second mortgage to put up their Airbnb in Kissimmee or something for the Disney crowd. Nobody's showing up. And what happened there is really simple, which is just that during the pandemic, there was a temporary shortage in Airbnbs because, people might have had a second home outside of New York that they were renting out on Airbnb. All of a sudden, they wouldn't be in New York anymore because of the zombie apocalypse. And so they went and occupied that and took it off the market. And then meanwhile, of course, you had hundreds of thousands of other New Yorkers who also wanted to get the heck out of Dodge. I mean, especially when they shut everything down, like the only reason you live in New York is because there's always stuff to do, right? Like if everything's closed in New York, it is horrific. Like I would much rather be on some remote island. It's a horrible place. And so you had this perfect storm where all these Airbnbs were coming off the market. You had just this flood of people who were going out and trying to get them. And when they got them, they would stay there for like 3 months, 6 months, 9 months. So all of it was off the market. And that meant that the Airbnb prices were absolutely astronomical. During the pandemic, we had to move from Canada to New Hampshire. And I mean, it was insane. You had like little cabins in the woods, hour and a half from anything, and they were like $2,500 a month. It was just, it was insane. Yeah. So people looked at that and they got excited and they said, holy moly, I can retire on my Airbnb. And so you had this flood of new supply. So all these people financed their Airbnbs and the market was flooded. And so now all we're seeing, I think rates are down 13% year on year. That's not catastrophic. But anyway, they're...
Well, rates of what? Rates of what?
The returns that people are making on their Airbnb. So that's host revenue is down 13% year on year. Across Airbnb, that brings it to about $1,200 a month. It's not terrible. I think the problem is that a lot of people were expecting 5.
I saw they were down about 3%. So I have to go back and look at the data that I saw on that.
Yeah, this is Bloomberg. So
okay.
I'm not saying that's necessarily the truth, but anyway.
Yeah.
It's also, of course, depending on the city. So, in some places I would, I don't know. But yeah, so a lot of the markets are down.
So they're saying as a whole, the median income has dropped by 13%.
Correct. Yeah.
And that could be, for some people, could be a make or break number.
That's the issue, is if people went into it thinking that they were going to make $5,000 a month and they're actually only making $1,200 a month, then did they get too much mortgage for it? I think also what's happening now, it's not just the revenue that's declining, the level of service that's expected has gone up a lot, which is a form of, the customers getting a cheaper price, is that they can demand more. So, people expect designer appliances, outdoor kitchens. They want the shampoo and the little soaps and, the little towel arranged like a swan. So all of this is costing more time for people. So people might have thought that they were just going to do this little side gig. They were going to have the thing. They were going to pay, whatever, some local handyman to go square the place up and take the sheets down. And now it turns out they have to put a lot more into it. So I think a lot of people they're going to give up on it. They're going to decide all that work was not worth $1,200. Plus you got to carry the mortgage. So I think a lot of people are going to exit from it. We're going to hear a lot of people talking about the Airbnb bust. Fundamentally, I don't think that that's the kind of story that's going to take housing down. I think it's a very sort of specific story to Airbnb, exactly what the process is. I think overwhelmingly for real estate, the question is simply going to be inflation.
So I guess you're saying that to your point, 9 out of 10 businesses fail.
Right.
These guys were starting a business.
Yep.
And most people have no business starting a business.
Yes.
And so they just typically fail. And these guys chose a particular business that got in at the wrong cycle.
Yep.
Too much supply, not enough demand.
Right.
They're going to go out of business. That's just the way market cycles work. But I guess the question I'm trying to get to and see what you're deciphering here, but a lot of people are saying that this is the apocalypse. This will be the prick that pops the real estate bubble. Are you saying you don't think that's the case?
I don't think so at all. I think housing, just because it went up a lot doesn't mean it's necessarily going to go down a lot. This is not how the world works. The houses aren't, remembering the good times and looking for payback. Okay, the houses don't care. The question is, what are the external dynamics that are driving those prices? And I think in this case, a huge part of it has been inflation. Housing is not massively overvalued comparing to what inflation did the past couple of years. I think you might be looking at about about a 10% overhang. That's not huge. It may lag inflation for a couple of years while that catches up. But at the same time, if we come into a recession, then where else are you going to park your money? Housing becomes even more attractive. Once we get into the recession, the Fed's going to cut rates again because that's what they do. At that point, a lot of people might decide to go out and buy a house, whereas right now they're scared off by 7.5% mortgages. So I think there's a lot of dynamics there, and certainly, first off, I don't think Airbnb can prick anything. It's just not substantial enough. And secondly, I think that...
Right, it's not substantial enough, and it's decentralized enough. It's kind of all over the country.
Right.
Like you said, Kissimmee or whatever. That's kind of the way that I would look at it as well. The other thing is I always like to get people to challenge these assumptions they have. So people are like, well, with rates as high as they are, then prices have to come down. I'm like, no, they don't.
No,
people will
on
just
the
buy a smaller
contrary.
house.
Yeah, well, and
just buy a smaller house.
Well, and also sellers are locked in is the issue at the moment, right? So housing inventory, despite these high prices, housing inventory for sale is like half what it normally is. And the reason is because if the seller, right, he's sitting on a 3% mortgage right now, and if he sells, well, he's got to live somewhere. And so, he wants to move to Florida or something. Well, he's going to have to buy a house at 7.5 in Florida, right? So a lot of people are effectively locked in. They don't necessarily like the house they're in for whatever reason. Maybe it's too big, it's too small, it's in the wrong place, whatever. But they're not selling right now because the rates are so high. They can't trade into the 3% mortgage. It's not like you can just take the 3% mortgage and say, okay, give me credit on this house. Alas, it doesn't work that way. On the contrary, the high rates, I think, are actually holding prices up because they're keeping people off the market.
Man, I think with that, we're going to break right there. Man, we have covered so much ground. There was obviously more we could have covered, but I think that's good enough for now. You're a wealth of information. I love it. I appreciate it. I know you make videos every day on Twitter or on YouTube. Why don't you shout that out?
I post them every day on Twitter. They're about freedom and economics, so basically what's going on in the world. I'm an Austrian economist, so they're from that perspective. And then I also do them on a podcast, and I do a weekly newsletter, like a Substack, where it goes into more depth. Yeah.
Well, I appreciate you taking the time to talk to us. It was a fun conversation. Looking forward to hanging out with you in Amsterdam here coming up in a couple weeks.
Yep.
And with that, we'll go ahead and sign it off. Thanks so much.
All right, Mark. It's a pleasure.